Hey everyone, welcome back to Corporate Decoder. Today we're diving into the financial world of the Federal Home Loan Bank of Cincinnati. It might sound like a snooze fest, but trust me, their debt is more exciting than watching paint dry, especially when we talk about millions of dollars. This report is called an 8K, which is like an urgent update a company sends to the Securities and Exchange Commission, the SEC, when something important happens. This particular report is about something that happened on February 12th, but they're reporting it on February 18th of 2025. The company we're looking at is the Federal Home Loan Bank of Cincinnati. It's basically a bank for banks operating under the rules of the United States government. They have a file number for official tracking. They also have an employer identification number like a social security number for businesses. Here's their phone number if you ever want to give them a ring. There are a few boxes checked as note about if other rules apply to this filing. It's basically saying this filing is straightforward. This indicates they are not a smaller emerging growth company. Now we are getting to the juicy parts. This section is about them taking on debt, and the official term is creation of a direct financial obligation or an obligation under an off-balance sheet arrangement of a registrant. Sounds complicated, right? It just means they're borrowing money. The bank gets most of its money by selling debt securities, which are like IOUs called consolidated obligations. Think of it like this: the bank sells these IOUs to investors, promising to pay them back later with interest. These aren't just Cincinnati's problem, by the way. All 11 federal home loan banks are responsible for these debts. These consolidated obligations are sold to the public through the Office of Finance, which acts as a middleman using authorized dealers, people who are allowed to sell these securities. The money to pay back these debts comes from the 11 federal home loan banks. The United States government does not promise to pay these back. Schedule A is like a list of all the consolidated bonds, essentially debt, that the federal home loan banks have committed to issue where Cincinnati is mainly responsible. It also includes bonds that Cincinnati took over from other banks, ones lasting longer than a year. Short-term debts called consolidated discount notes aren't included here. It's worth noting that how they are reporting this information might change. Even though issuing these debts is important to the bank, they're not saying any specific debt is particularly important. The list doesn't include any side deals, such as interest rate swaps, which might be connected to these bonds. It means they might have other agreements affecting how much they actually pay in interest, which isn't fully disclosed here. The list doesn't show all changes in the total amount of debt Cincinnati is responsible for, since it doesn't include information about paying off old debts with the money from new ones. You can't see the big picture of their debt from this report alone. The amounts listed are just the face value of the bonds, not what they might actually be worth based on discounts or premiums. This means the actual financial impact could be different from what's listed. It's important to know that this list doesn't include all types of bonds that other federal home loan banks might issue. Cincinnati is only reporting what they're directly responsible for. Now let's look at Schedule A, which details the debt. The first bond was traded on February 12, 2025, identified by code 3130B54M7. The settlement date, when the money changes hands, is February 18th. It matures, meaning it needs to be paid back, on September 18th, 2025. The next interest payment is due March 18th, 2025. It cannot be called back early and has a variable interest rate. The total amount of the bond is $500 million. The second bond was also traded on February 12, 2025, but this one matures much later on February 12, 2030. The next interest payment is August 12, 2025. It can be paid back early and only at a specific time. It has a fixed interest rate of 4.75%, and the total amount of the bond is $15 million. The third and fourth bonds are identical to the second bond, also for $15 million each, meaning in total they issued $45 million of this particular bond. Call/amortization type description. These descriptions explain when and how the bonds can be repaid. Optional principal redemption bonds, or callable bonds, can be redeemed by the bank at its discretion on certain dates. Indexed amortizing notes, or indexed principal redemption bonds, repay principal based on a schedule or formula linked to a certain index. Scheduled amortizing notes repay principal based on a set schedule. Call style description. This explains when the bond can be redeemed early. American bonds can be redeemed any time after the first redemption date. Bermudan bonds can be redeemed on specific recurring dates. European bonds can be redeemed only on one particular date. Canary bonds can be redeemed on specific recurring dates until a date before maturity. Multi-European bonds can be redeemed on particular dates only. Rate type description. This describes how the interest rate is set. Fixed bonds have a constant interest rate. Variable bonds can have different interest rates over time. Rate subtype description. More details on the interest rate. Constant bonds have a fixed interest rate. Single index. Floater bonds have an interest rate that changes with an index. Step-down bonds have decreasing fixed interest rates over time. Step-up bonds have increasing fixed interest rates over time. Step-up-down bonds have various fixed rates over time. Zero coupon bonds don't pay interest until maturity. Capped floater bonds have an interest rate that cannot exceed a certain limit. Dual index floater bonds have an interest rate based on two or more indexes. The leveraged bonds pay interest based on a formula with a multiplier. Inverse floater bonds have an interest rate that increases when an index decreases. Stepped floater bonds pay interest based on an increasing spread over an index. Range bonds may pay different rates depending on whether an index is within a certain range. Ratchet floater bonds pay interest with increasing minimums. In conclusion, the Federal Home Loan Bank of Cincinnati is actively managing its debt through various types of bonds with different terms. Now, let's break down what this all means. Direction. It seems like Cincinnati is strategically balancing its debt portfolio. The mix of short-term variable rate debt and longer-term fixed rate debt suggests a calculated approach to managing interest rate risk. However, the reliance on debt to fund operations is a weakness. The bank needs to ensure it can generate sufficient income to cover these obligations, especially if interest rates rise. Risks. The biggest risk is clearly interest rate risk. A sudden increase in interest rates could significantly increase the cost of borrowing, impacting profitability. Also, any economic downturn could impact the ability of member banks to repay their loans, which would then impact Cincinnati's ability to meet its debt obligations. Opportunities. The bank could explore innovative financial products and services to increase revenue streams and reduce reliance on debt funding. They could also focus on strengthening relationships with member banks to ensure a stable customer base. Stock price outlook. It's tricky to give a stock price outlook because the Federal Home Loan Bank is not a publicly traded company in the traditional sense. Instead, it's a cooperative owned by its member banks. It is not traded on public markets like the NYSE. However, to the extent that one can evaluate their financial health, we can say this. If this bank were to be valued as a standard bank, given its debt levels and the current interest rate environment, a reasonable price to book value would suggest that their implicit share value is slightly overvalued. Conclusion. Overall, I'm cautiously neutral with a slight bearish bias on the Federal Home Loan Bank of Cincinnati. They're operating in a complex environment with significant debt, and while they seem to be managing it strategically, the risks are considerable. There is no recommendation to buy, sell, or hold. This is because this entity is non-public and it serves more to educate on debt obligations in general. Thanks for watching. If you found this decoder interesting, please subscribe for more videos simplifying the world of finance.